Hello, and welcome to another episode of Market Pulse. Today, we will talk about pullbacks and show you how to use this goldmine concept with liquidity areas on the chart to stay one step ahead of the market. Mastering this concept will give you an edge in executing winning trades and mapping market structure. Additionally, we will show you how to combine liquidity sweeps with pullbacks to create a solid trading strategy that offers a very high probability of success in the market. So, traders, if you find this content valuable, please give this video a thumbs up to show your support and subscribe to our channel if you're new. Before diving into the basics of candlestick pullbacks, let's quickly break down candlestick uptrends and downtrends. A candlestick-based uptrend is characterized by a pattern in which the price action produces consecutive bullish candles, with each candle exceeding the highest point of the previous one, signifying strong upward momentum. For a single bullish impulsive movement, it is essential that the lowest point of each candle remains equal to or higher than the lowest point of the previous candles. This condition indicates that the bearish momentum in the market is restricted and the overall trend remains predominantly bullish. The same concepts apply to the bearish scenario. A candlestick-based downtrend is characterized by a pattern in which the price action produces consecutive bearish candles, with each candle exceeding the lowest point of the previous one, signifying strong downward momentum. In a single bearish impulsive movement, it is crucial that the highest point of each candle remains equal to or lower than the highest point of the previous candles. Now let's see how we can identify valid pullback in the market. In the bullish scenario, valid pullback occurs when a candle breaks below the lowest point of the previous candle or effectively sweeps its liquidity. For example, in the given illustration, the last red candle has broken below the lowest point of the third green candle, indicating a valid pullback. It's crucial to note that if the price fails to break below the lowest point of the last green candle, the pullback cannot be considered valid. It's important to emphasize that the color of the candle does not play a role in identifying pullbacks. Similarly, in a bearish scenario, a valid pullback occurs when price breaks above the highest point of the previous candles, sweeping liquidity in the process. To solidify our understanding of pullbacks, let's examine more examples. Consider a series of bullish candles as illustrated. After forming 3 consecutive bullish candles, the price forms a temporary pause, marked by the emergence of 3 bearish candles, before resuming an upward push. As previously mentioned in the context of a bullish scenario, for a valid pullback, the price must break below the lowest point of the last bullish candle formed just before the temporary bearish pause. However, it does not qualify as a valid pullback, because none of the bearish candles has broken the lowest point of the preceding bullish candle or swept its liquidity. Consequently, we consider this candle sequence as a bullish single impulse move. In a parallel scenario occurring in the second candle series, we can see that after the formation of successive bullish candles, a temporary pause occurs with the emergence of a single bearish candle, since the price has not broken the low of any previous candle in this sequence. So we cannot consider it a valid pullback either. On the contrary, if the bearish candle forms an equal high with the previous bullish candle, and the subsequent candle breaks and sweeps below the low of the bearish candle, it qualifies as a valid pullback. So here we have a bullish impulsive wave, followed by a correction, and then another bullish continuation wave. These concepts apply to bearish markets as well. We now can identify valid pullbacks in the market, enabling you to map the market structure easily. In the second part, we will explain an accurate and advanced pullback trading strategy that offers a high probability of success in the market. This pullback trading strategy is called the sweeping pullback model. In this type of pullback, the price generates liquidity pools near our point of interest by forming static liquidity zones, such as equal highs, equal lows, or trendline liquidity. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial, as this pattern confirms the strength of our supply or demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before reaching a key level, it often uses that zone as liquidity to fuel its momentum. For example, here we can see that price retraced back down, formed equal low, and also has created a great liquidity below the double bottom, suggesting the presence of pending orders and stop losses waiting to be triggered and swept by the market, which is located in the near of our identified demand zone. By focusing on zones with liquidity sweep patterns, we can increase the probability of trading setups that align with market dynamics and reduce the risk of falling into false signals or traps. The presence of the liquidity pool above our identified demand zone provides additional confirmation for a potential price reversal from our point of interest. Now that we have the desired confluence, our next step is to patiently wait for price to sweep the liquidity below the equal lows. Now we have our desired confluence, and now we can consider to enter into the market by going long from our point of interest. For doing that, we can place our buy limit order at our demand zone. If we want to optimize our entry point and having better reward to risk ratio with tighter stop loss, we need to zoom into a lower time frame and wait for price to tap into the demand zone and shows a change of character or any market structure or shift signal. And after the formation of the newly generated demand zone on the lower time frame, we can consider to place a trade. Now let's look at an example. Here, we have the euro-dollar 1 hour time frame. As you can see, the price has created a bullish break of structure and left significant inefficiency behind. This gives us perfect demand areas at the bottom. Following this, the price enters the pullback phase, pushing downward and creating a perfect liquidity pool by forming equal lows located just above our point of interest. The next step is to wait for the price to sweep the liquidity below the equal lows. Now, let's play out the price action and see what happens next. As you can see, price pushed lower and swept the liquidity below the equal lows. In the next step, we need to execute a buy order and enter the market. There are two possible options for placing an entry. We can opt for a single time frame entry on the current time frame, or choose a more conservative approach by seeking additional confirmation, such as waiting for multiple reversal patterns like a change of character or other reversal patterns. For this example, I'll use the single time frame entry model and place my buy limit order at the highest point of the demand area. As for the stop loss, I'll position it a few pips below the demand area. For the take profit, I am targeting the buy side liquidity above the swing point. As we prefer not to keep our positions open for an extended period, as our entry is executed in 1 hour time frame. Now, let's play out our trade. As you can see, price pushed higher and finally hit the take profit,